Hey everybody, this is Jose. We are about to get started. I wanted to have a quick sound check. If that's okay, quick message on the chat box to say hello. If you do that, then I know you heard me and I know sound is good. So we are ready to get started. So please go ahead and just have a kind message on the chat box. So I know you heard me and it's a good and nice way to begin the session. I want to turn on the video stream as well. How are you, everybody? I'm saying hi here from my bottom right corner as always, and eager and ready to begin the session in 25 seconds. How are you, Joe? Good to see you. Good to see you, Jerome. Good to see you, everybody. Very nice. Again, almost there. 10 seconds to go and we begin, guys. Thank you for those hello messages. Thank you so much. Cool. Top of the hour, everybody. Welcome to the session. This is Options with Options, November 3, 2021. My name is Jose Blasco. I will be leading the session today, as most of the Wednesdays and Thursdays, as well as the Sundays when we get together to talk options. And as the name of the session suggests, of course, today we are getting together to trade options. The markets are open, so we're going to be looking at opportunities. We're going to be looking at positions that we have, etc. Before we get started, I would like to highlight, as always, our disclaimer on the upper left side of the screen. Please read it carefully. This is important information. Do not skip it. It doesn't take much time. A couple of paragraphs. It's a good piece of advice because trading is indeed a risky business. There is money involved. And for the ones of you with experience, you know. For the ones of you who are newer to trading, you may not know, and it's important that you do. So please read the disclaimer carefully. Thank you so much. Agenda for today, we're going to be looking at the market, understand what's happening out there first of all. From there, we'll look at the trades that we have in the account running at the moment. We'll talk about if anything needs to be done from a trade management point of view. And from there, we'll move into looking for new opportunities, which typically we have more time for that on the Thursday, but we'll try to do our best. Siderman, good to see you. Jeff, good to see you. Joanne, good to see you. Good to see you, everybody. Very nice. And also, I'm not sure if Maka is around. Maka, are you with us? If you're not, maybe you're coming just a bit after, I guess. But Maka also had a question sent to me in an email related to options assignment, options expiration, options exercise or auto exercise. And I wanted to go over some of that because it's indeed impactful in a good or a bad way if you know what you got in your hands, or if you're not sure of what you got in your hands and you're stepping now into expiration day, okay? Chuck, how are you, my friend? Good to see you. Seabuck, love it. So anyway, so let's begin the session, everybody. Quick reminder, as always, we have our question page, our help page, tradewithufos.com/the name of your instructor. Today is Jose. So you can use my name if you are attending a session with Becky, with Boyan, Pedro, Reynaldo, you name it. So just use the name of your instructor and you get to the question page where you can post your questions, import or insert screenshots of your charts and so on. And that way, in the bottom part, we are building a very healthy database of very smart questions and very good answers all together, where you guys can come here and search, and the more we all participate, so the more relevant this database will become and more useful to everybody. So while you are welcome to send emails, of course, if your subject or question is not private, meaning something related to something that you are currently doing in your account that you don't want to disclose, I would like to encourage you all to please use the question page, as this is way better for the community, apart from yourself. And I know all of you appreciate that as well. Thank you so much. So anyway, let's begin our analysis and trading. Here, stop. We got the chart of the S&P, and let's begin the planning. Mike, I see you are here. I was just talking about you. Not sure if you heard me when I said, I was saying that, today we're going to talk a little bit about options expiration, assignment, exercise, auto exercise, all of those things. How are you, Clive? Nice to see you, my friend. Very good. Okay, so the S&P. Well, how do we call this? Amazing, right? Really, really, really amazing. And what a move. So we were coming from a few weeks ago from moves to the downside that were unlikely to happen. Probability suggested duration of down climate to be 2, and we had this very, very lengthy duration of down climate. That was surprising in the sense that statistically it was not supposed to happen, and it did. Again, this is not the first time we see things like that, but it was indeed an event, because then it happened again in the next cycle, okay, and almost again, okay, in the next cycle. So it was looking like the market was gaining a lot of weakness based on that. But then what happens is that on the weekly time frame, we switch to an up climate, and next thing you know, this pushed the daily time frame to levels that are way beyond what probabilities suggest. Probabilities suggest that an up climate should be a move that in most of the cases would last around 6 candles at a time, and then retrace, and then push again, and then retrace, and then push again. And in the current push that we have in front of us is been already lasting for 14 candles straight, 14 candles that mean the criteria that AutoClimate is looking for. So that's impressive. That's very strong. For sure, the fact that we started making all-time high is also a catalyst, okay, because you can see the indecision that took place at this moment in time, and you can see that the moment the market started breaking up and some people took profit, immediately many people use that to re-enter, and all this excess of buying is really pushing the prices higher. Today, minus 0.14%, but indeed, amazing moves. Now, having said all of that, and even though I used the word amazing multiple times, this is something that happens, and we don't want to be emotionally impacted of whatever the market does, no matter if it's good or bad or boring or exciting or strong or weak. And we've seen this before, and even if you didn't see it before, the reality is that we all know that probabilities are there to be met most of the times, but also to be invalidated or broken sometimes, less often, but it happens. This is the case. Okay, 14 out of 6 is a clear case where probabilities are not meeting reality. Okay, so now what do we do? Okay, are we gonna just now bet the market is gonna continue and double its price again? No, because again, while the move is spectacular, the reality is that the normal thing to happen based on probabilities, okay, is to have that retracement. Okay, so in the prior week, we had the implied volatility of the calls, blue color, above the implied volatility of the puts, gray color. This was probably the energy behind the scenes producing that. Okay, now we are back to a fight. Okay, it's funny because it's looking like I kind of feel like that, to be honest. It's looking like that when we meet on the Wednesdays, it's kind of like it's when the market wants to take a pause or a breather or something. Notice how I think that last Wednesday we met, we were here, where the value for the puts and the calls was exactly the same. And now guess what? We are back in a situation where the value for the puts and the calls is exactly the same. And therefore, from behind the scenes, it's very difficult to see. You can see here 1133 for the calls, 1143 for the put, implied volatility, real-time implied volatility. And therefore, from what we could get from the behind the scenes, it's very difficult to know what's going to happen. If we get deeper into the volume map, while we can see that the calls are kind of gaining, okay, on the next expiration date, they're not, okay, and while the front week, okay, which expires on the 21st, what did I say that right? No, cannot be on the 5, correct? I don't know why I said 21st. On the 5, we can see the options are slightly above the average volume, but every one of the other expirations, we are very far from the average, which means that probably a lot of the trading that is happening in this front week expiration has to do with micro hedges that traders are doing, putting some either very short-term trades or hedging whatever profits they have made here on the way up. They are hedging it, in case there is some sort of a correction that lasts a few days. Because again, the professionals are looking at the markets the way we do, which is, if there was to be a correction, it's likely to last for a little bit only and then continue to the upside. That's what's likely going to happen. at least based on the probabilities and the mechanical assessment of the markets we are doing together. So what do you do as a trader? Well, you gotta load the gun in both directions, because at this stage we may have a bit more of a push to the upside, because this already has broken what statistics suggest, so you don't know what to expect. I mean, it's more likely going to retrace than not, but I said the same last week and it didn't happen. So you need to load the gun to the upside just in case, but you also need to load the gun to the downside just in case. So if the market was to actually fall for a few days, you can actually use those short trades to hedge the pain your long positions will get and make a profit on that short. And then you close it, and then if the market comes back up, now you're back in business while you collected a profit on the way down as well. So same as I said last week, I believe it was on the Thursday or the Wednesday, I'm not sure. My plan today, when we get into looking for trades, will be to find longs and shorts both. Okay, and of course, I would also love to find non-directional trades, but if we look at the VIX, we are talking about levels of 16, which is more or less what we got last week as well. It went a little higher in the later stages of the week last week, all the way to 17.5. But again, nothing that spectacular. So volatility is not so high. So selling premium will probably take a little bit more research. And therefore, just to have an easy way to participate of the market and be protected, first, I would like to find a long and a short. And from there, I would look into non-directional opportunities. Okay, so this is a little bit of my view of the markets. And when I say my view, it's because it's my view, but at the same time, it's not my view because I have a special way to look at the candles on the chart. It's just because I am basically looking at the objective data that is being thrown at us through the apps and basically adding human words to the mathematical numbers that we see. Okay, and the one last thing I would like to say is that UFOs keep popping up. Okay, we had UFOs a bit lower before, right? So if I go back in time, for example, here. So if I fast forward, okay, we got that UFO that showed up. Okay, price came back to the UFO and continued. Then we got a little bit of selling, but that was taken out. Okay, because remember, in an up climate, sell on field orders are often canceled. Okay, and from there, the market continued going higher, and we know we have a UFO right here. And very good point, Joanne. The FOMC statement, that could be one of those news which may be the catalyst for those buy on field orders that are currently located at 459 to be canceled. And next thing you know, the market now has room to fall all the way to 454. And that probably takes 2 days or 3. That would be a very fair and reasonable correction to expect based on the reading of the auto climate that we just discussed. Okay, so these are the challenging times when it comes to trading. Okay, these are the times that I appreciate the least, even though it happens when the market is out of what probabilities would suggest, because then it's not like you have a clear action to be taken, and you always need to protect your bets, because if you bet too hard in one direction and you end up doing well, let's face it, you've been lucky. And if you don't protect yourself well, then you can get very badly hurt. So again, this type of market condition gets you a bit more work, because you need to maybe get more trades, some long, some short, just to work on your portfolio a bit more to be protected. But at the same time, it's something that when it happens, you gotta react to it. You just cannot do nothing about it. Like, some people would look at this and they would have these very strong opinions about, this is crazy. There's no way it's gonna continue, right? So okay, so no way is a word traders we should never use. Those absolute statements, okay, bias you at an unconscious level when it comes to trading, and you may get into trades where you are basically fighting the market. So you just cannot fight the market. At this moment in time, the climate is blue, so the market is moving higher. That's a fact. So getting long trades is definitely not a crazy thing to be done. But at the same time, because probability suggests it's going to retrace, so you want to protect yourself. And when that's the case, you have a bit more work to do. But just accept it. Okay, don't fight it. Don't look at it, from that point of view. Like I've heard so many people throughout the years, and even in the media, and so on. Some people talk about their opinions about the market is like, I don't know, like they know better or something like that. So again, the market is doing its thing. We need to remember that even if we are not in a trade, the market is doing its thing. even if we are in a trade, even if we have our account loaded with trades, the market is doing its thing like we're not there. So the market doesn't owe us anything. There is no reasons or needs for us to say the market is crazy. Say it doesn't. I mean, it's great for conversation with friends or having a coffee, but when it comes to trading, wear that trader hat. Just be objective. The data we got, know that probabilities are there to be met more often than not, but probability are there to be broken from time to time. That's why we manage our risk, and with that kind of mindset, just go and trade. And that's the healthy way to approach it. Okay, so again, just adding a little bit of a few comments related to trading psychology, if you don't mind, because it's absolutely critical, and these are challenging times indeed. Okay, good, wonderful. Looking at the comments on the chat boxes, everything seems to be okay. Good, perfect. Okay, so let's begin reviewing our positions. Okay, so first of all, we got the Colgate-Palmolive trade that we had. We built this position before. And then we evolve that position into a more complex type of position. Okay, and so basically this trade, when you look at it here, if you left it all the way to the end, it shows a $94 loss. But the reality, and please guys confirm that, the reality is that you had a clear opportunity. I did close it. Okay, so if you look at my account, is not there anymore. I closed it. Okay, and by the way, it will not be there even if I didn't close it because those options expired. But I did close it when that stock was trading around 77, which happened the other day. Because 77 was the middle point where we had multiple short units, it was going to be the place where we would make the greatest amount of money. Okay, so that was at that moment in time, around 77. I closed this trade, and this trade was closed for a profit. I don't remember exactly how much it was. I think it was around $30 per contract net for the whole thing, and which I would call a success in the sense that this trade went against us all the way for a long time. Okay, so we got into this trade when the market came into our speed bump. Okay, and all this price action was against us, and then a little bit of hope, but then against us, and then a little bit of hope, and then against us. So really, it went nowhere. Okay, we never reached the target we were planning to hit, but we managed with our tweaks, our options conversions, okay, or additions, we managed to reconvert this directional trade into a non-directional trade, and actually we closed the trade for a profit. Okay, so that was hopefully a good experience for you guys, especially the ones of you new to the advanced management of trades that we are doing. That I spend plenty of time on the Wednesday, and so hopefully these are aha moments, and now you understand why I spend so much time explaining it, because this basically converted what a losing trade was to be a winning trade. Okay, Maka, that's exactly what I needed to do, but didn't think fast enough. Got you. Okay, so this will come with experience. Okay, this will come with experience. But if let me bring a race graph. If anytime, no matter the stock, no matter the expiration date, so anytime you build a strategy, in this case, I'm going to get a short arrow butterfly, but it could be a calendar. Anytime, let's do a calendar. Anytime you have a shape which is kind of like a triangle, right, which is what we had on this trade. So the midpoint of this triangle is where you get the maximum profitability. Okay, that's the midpoint. And every time you have a midpoint, you have a triangle type of race profile, you never know where the stock is going to be on that expiration date. You never know. Because, when you do, like, let's compare this, for example, with an Aaron Condor type of trade. So let's do short Aaron Condor. So what's the difference? With an Aaron Condor, you got this flat chart where no matter if the stock is trading all the way to 78 or all the way to 76, okay, no matter where the stock is, you would end up making a profit of, orange line is $55. Okay, so no matter what, no matter where the stock is in that range, between 76 to 79, I believe I said, or something like that, so you will end up making $55 no matter what. So when you do an Aaron Condor or a trade that gives you a risk profile which is flat, it's very simple. You don't need to shoot for a target as long as you are um, within the range on expiration or before expiration, you're fine. That's it. But again, let me get rid of this one. Every time you have a trade that has a triangle shape, you know that from, in this case, 75.75 to all the way 79.36, somewhere between those two price points, you're going to make a profit. But the profit will not be $55 no matter what. The profit will depend on where the stock ends up on expiration. So if the stocks end up at 78.43, you're going to make $31, okay, at 78.43. But what if on expiration the stock is trading at 76.99? So then you're going to make $47, which is more than 31. What if the stock is exactly in the midpoint? Well, at 77.5, you're going to make the maximum, which in this case is 71. So that's the type of risk profile that we got with CL when we did all those different conversions. I could not chart it anymore because those options expired. So if I right click and I look for a risk graph, it's going to show nothing. It's blank because those options has expired. So unfortunately, I cannot chart it. But if you go back to the recordings from the prior session, you would see how the risk graph is a triangle shape. And when that's the case, it's indeed, especially as you're approaching expiration, it's indeed very smart to set your exit to be at or around that midpoint, because that way you're going to maximize your profitability. Even if the stock ends up in the range, there is no other place that pays you the most than when you reach that midpoint of the triangle, which in the case of Colgate-Palmolive was 77, because notice if I zoom in, okay, if I zoom in, we were selling two options at 77. So that's a great place for you to exit your trade and maximize the performance. So again, this trade ended up as a profit, even though here, as the trade is dead, as those options have expired, we see a minus 94. This trade actually ended up as a profit if you had managed it the way I just suggested, which I did mention that in the sessions. Okay, so make a note, guys, and of course, if someone didn't get it when I said it, or you were not in front of your screen, or whatever. I mean, we are human. It's okay. We are shooting for perfect management. Sometimes it's not possible. So then it's okay, no problem. The risk got limited risk. No matter what, the most you could lose in this case was 94. So it's not a big deal. But at the same time, hopefully, having practiced this trade that we entered some time ago, see the stock go against you, manage it, massage it. Give the trade a second chance to give you a profit and exit for a profit. That I believe was a great exercise and a great practice, hopefully for a bunch of you. Okay, guys. Ahmed, I didn't want to assign, so I'll roll over the next week, hoping I can close the long call. But so far, still have it. Okay, so definitely those are valid management rules to roll out in time. But as long as you have rules that tell you when to do that. Okay. In my case, I would not have done it, Ahmed. And again, we don't need to trade the same way, okay? Because we are different people and therefore we have different trading plans. So we don't have to trade the same way. But in my case, I would not have done it. And here is why. When the stock came to the speed bump, we got into a trade that was directional long. It absolutely didn't work for us. Like it went against us all the way, all the time, right? So then we converted somewhere around those dates. We converted the trade from a directional to a non-directional trade. And therefore, you had an opportunity to exit for a profit in a non-directional environment. So I would say get out. Why? Because now if you add more duration to those calls, basically now you are assuming you're assuming risk for a longer time. And what if the market condition doesn't meet your criteria to be in a non-directional trade, right? So in my case, I was moving from directional to non-directional as a defensive mechanism because I was in damage control mode, right? But remember, if I was to look for non-directional trades, okay, I would come to the matrix, I would come to the strength, and I would select a strength for daily and weekly to be neutral, right? So now the question is, when you rolled those options to the next week, did you have a neutral reading on the weekly and the daily time frame for CL? If the answer is yes, so then I guess, at least based on my rules, then yes, it's a great action where you are giving the trade a third chance to profit, and actually now to profit even more because you're getting more premium as you roll out in time. But the market condition goes with you hand in hand. Why? Because it's a neutral market condition. So betting for a longer duration of a non-directional setup makes sense, right? But that was not my approach when I did it. When I did it, it was just a defense. It's like, okay, this trade is going to lose. Let's try to give the trade a second chance, or at least reduce the risk. And that's what we did, and we ended up with a profit, which is not always the case when a trade goes against you. In this case, it was the case. So again, rolling out in time, just make sure you have rules for that. Just don't do it because you're looking at the trade and it's like, what can I do? What can I do? What can I do? And you are trying to get creative. And by the way, you guys know a lot about options, so your creativity is needed. And when you're looking at alternatives, it makes a lot of sense. My point is, make sure you don't forget the technicals, and you look at the chart to make sure the market conditions accompany whatever technique you are using when you are tweaking your trades. If that puts you in a scenario which is beyond the match control mode. Okay, to me, the match control mode started when the trade started moving against us, and the match control mode ended up on October 29, which is when that trade expired. If you give the trade more time, then to me that's not the match control mode. That is now you are trying to make money. It's almost like a new trade. Okay, so that's why I'm re-emphasizing and persisting with this concept of make sure you look at your technicals. So, because again, options are amazing and we can do so many things with them. We just converted a losing trade into a profit, so it's amazing. But if the market goes against you, it's most of the times it's going to be a loss. So the technicals, you cannot forget that, and you need to have rules around that. Okay. Anyway, very, very long comment there, but again, this is very important. So hopefully you guys are with me, and this is making sense. Siderman, you lost $44 per contract, sold 200 shares. You sold 200 shares, CL at 3 markets 30 seconds before the close. Okay, so why did you do that, Siderman? I'm just trying to think about the rationale of why did you do that, because so this trade had all of the units that we were using in this trade were October 29. So for sure, if you were either above or below 77, you were going to be assigned, which we need to talk about this. This is something that we need to review today. So if you were above or below 77, you were going to be assigned, for sure. Okay. But my point is, why would you want to be assigned if you didn't have units that would continue beyond October 29? Is it because, and again, I'm not saying what you did is wrong, Mark. I'm just saying, is it because there was no bid-ask size at this moment in time and you tried to exit the trade and you could not because you waited too late until the end of Friday? Or, could you tell me a bit more about that? Because again, this is real critical, and this is a very enriching conversation for you guys when you find yourself, facing this trade on Thursday or Friday as expiration is really approaching, and you may run into certain trouble. So it's important that we discuss it. So that's why I'm asking if you could share a bit more of the details. It took until Sunday for my account to get settled. Well, it doesn't matter if your account got settled on, well, you know what, Simon, I'll talk about that later, because we need to talk about assignment. So I'll talk about that later, okay? But it doesn't matter that happened on Sunday, okay? I will explain that better in a moment. Maka, we just needed to be clear that at the 77 we needed to close the trade. I missed that if that was discussed. Okay, so we're gonna have a review. Okay, we're gonna have a review because our sessions are rich on possibilities. We call the session options with options for a reason, and of course this could get confusing and so on. You were not assigned. Okay, got you. Okay, Siderman, I will go ahead and look at your responses in a moment and re-explain properly the assignment exercise process, look at this very specific trade around the 77 strike and talk about it. Okay, cool. Next one in line. Okay, so next one in line is Pfizer. Okay, and Pfizer is a little bit of a better news, even though it's a similar scenario, where this trade is a trade that went against us all the way. And we entered on this particular day. I believe it was somewhere here. Yes, this is the vertical line. So price was somewhere here. Okay, it went against us all the way as the S&P was falling so hard for so many days. Remember, this is a 2-day time frame, so every candle lasts for 2 days. So that was a pretty long duration of the market going against us. And from there, the market has moving pretty strong in our favor. So this trade went from losing money to now basically breaking even, okay, depending if you are looking at the P&L at midpoint or not. So negative 0.5, negative 8, depending if you did the conversion or not, okay? So where are we at and what can we do with this trade? Because if you recall, first of all, this trade got more time to expiration until November 19. Now, let's face it, November 19, it's not that far, okay? It's not that far. So if we look at November 19 and we look at stats, so from now until November 19, which is here, so the statistics suggest that we may reach, anywhere between, here, anywhere between 47 to 48 something, okay? So 47 to 48 something, if I go back to my target is 48.24. So guess what? We may reach the target, okay? But it's looking like real tight, okay? Real tight. I would not be surprised that, especially on how strong this market has been moving, I would not be surprised that given the fact that the S&P is more likely going to retrace than not, we just have some sort of a pause here for a few days, and then we have another push, and then the options expired, and we never reach the target. This could certainly happen, okay? So I would like to look at this particular trade, and given the fact that we wasted so much time looking at this market going against us, now the probability of reaching the target on time is much less, and therefore I would like to look at ways where maybe I could remove now more risk out of the trade now that I've done what I've done, okay? So first, let's understand what is it that we had, past tense, and what is it that we have, present tense. So what we had, I'm just gonna do some drawing on the chart. So what we had is, first, we started this trade by selling 2 puts and buying 2 puts below. That generated a credit that we then used, okay, to somewhere around here, we bought a call. Okay, that's what we did. Okay, this is what we did. The call we purchased was the 47. So yeah, actually I draw it more or less where 47 is. Okay, so it's good. Good. So we sold 2 bull put spreads, we used that premium, and we purchased a call. Okay, but again, all of this happened, the market went against us, all of this. So now what? Okay, well, we decided in a prior session to take our 47 call, okay, and we went ahead and we sold 2 of the 48s and we bought 1 of the 49 against, creating a directional butterfly. So what we now have is, above the call, we have 2 short calls, and above the short call, we have 1 long call. So if you look at this by itself, and you forget for a moment that there are 2 puts below, 2 bull put spreads, I should say. So that combination of buy a call, sell 2 calls, buy a call, that is a directional butterfly, more precisely a long butterfly, in the sense that because it uses calls and because the short strike is above, you make money as the market rallies. Okay, so it's a long butterfly. Could be constructed with calls or puts, to be honest, but in this case, it's a very easy one to understand, isn't it? So what happens is that when we did that, we brought in some more credit, and we basically helped to reduce the net risk of the trade. So if you look at the original trade we had with the 2 puts and the call, this trade had a maximum risk of $200. When we brought in the butterfly into the mix, so we got this trade that had $200 of risk, we had this trade drop down from $200 to $146, and not only we did that, but now we ended up with a net credit of 14 cents, which is, I'm not saying it's a lot, but the beauty of that is that now, even if the stock was to fall all the way to 43, you would make those 14 cents. And if the stock actually rallies and reaches our target, by the way, take a look at this, my friends, middle point of the triangle, right? That's where we make the greatest amount of profit. So, if the market was to rally, so when the moment we reach 48 or 48.24, you want to take the trade out because this is the maximum profit that you're going to get, and we can get some more profit from this trade. So all is looking good in this sense. This trade made sense. Okay. Now, can we do something? Can we do something else to this trade to make it better? And the answer, to be honest, is going to be no. Okay. It's going to be no, at least for now. Maybe next week. Maybe if the market was to fall a bit, but not at the moment. Okay. And I will explain why. So when we sold the two calls that we, sorry for that, let me draw this again. When we sold the two calls, we got filled at 12 cents per contract. The current bid and ask price for those two calls we sold is trading in between 16 to 17. So in other words, if I was to buy back the calls, okay, I would actually buy them back for a loss. And that would increase risk instead of reduce risk. So I don't want to do that. Okay, I don't want to do that. Okay, now, because the market has been going higher, typically you would expect volatility to go down. Okay, let's take a look at what's the implied volatility for that stock. So volatility has been going down, okay, because that market was going up very, very strongly. So often volatility will go down when that's the case. And I was expecting that maybe the 48 call would have lost more value because of the time that has passed plus the drop in volatility. But it seems it's not the case, and probably it has to do with volatility smile. Not all strikes carry the same level of volatility. So if I look at November 19, and I look at the calls, and I look at a few calls, like you can see here how the 48 strike actually has a very, very high volatility of 25, where the at-the-money strike, which is 45.5, has an implied volatility of 20. So there is additional implied volatility in that 48 strike, and that's why that strike it's struggling to lose value, and therefore, from a trade management point of view, I cannot act yet. So if that strike, that 48 call, was to drop in value to 5 cents, then I would like to close it. Okay, I would like to close it. For sure, I would now have a net credit of 5 cents less, which would be 9 cents instead of 14. But now if the market was to rally, instead of a triangle shape, look what would happen. So if I was to manage to buy back my 48 calls at 5 cents, okay, look at what would happen. So now, if the market was to rally and rally hard, now I would start making unlimited amount of profits to the upside. Of course, I will need to see a spectacular move, which, again, we only have until November 19. I'm not sure that's going to happen. So I'm very happy with the setup that we have at the moment. But, this could be the case, okay? So from that point of view, I cannot close those calls yet, even though that's a good action, and nothing stops me from placing that order in the system now. I did a mini error in my calculation though. If I sell the options at 12 and I buy them back at 5 cents, I said that my current credit is 14 cents, and 14 minus 5 is 9 cents. But that's not correct, because I got 2. Okay, I got 2. So you need to think of 10 cents. So 10 cents, less than 14 actually is 4. Okay, so you would make $4 instead of $14 instead of, what I said earlier, which is 9. Okay, so just a little mistake there because it's 2 units instead of 1. So nothing stops me from placing an order to get those calls out. Okay, the 48 calls. Right click, create a closing order at 5 cents. Good till cancel. Don't make it the order, good till cancel. So whenever this happens, you are out. Maybe tomorrow at the open, there is a strong gap down. You get rid of the calls, and then Pfizer continues to the upside. Could be. You never know. So have the order in the system. So if that's the case, that order will trigger and you'll get rid of those 48 calls, opening up more profitability to the upside if that stock was to rally strong. So that's an action to be taken. Okay, but of course we didn't get filled now because the current price is 16, 17. So this is in the account just in case. What else can we do? Okay, what else can we do? Maybe. Okay, what else can we do? Maybe. So let's take a look. I'm just gonna analyze this from a different angle. Okay, so I'm just gonna compare spread. Let me take a look at the chat box. I haven't looked at the chat box for a while. You know what happens on the Wednesdays when I get talking about trade management? There are so many, micro discussions to have within the conversation that requires a lot of your focus, and sometimes it requires me to use plenty of time and go back and forth from matter to matter. Maca, Jose, it doesn't make sense to continue to take these trades, especially in live accounts, unless we manage the exits properly. Can we set closing orders as we manage the trades? Yes, of course, Maca. That would certainly help a lot. Now, every one of you is using a different platform, and one of the things that I plan to do on the Sunday sessions is to talk about order placement for different platforms. For sure, as long as you know how to place those orders, go for it. Just like right now, I just placed an order to close this trade at 5 cents. I could actually have done this on the very same day when I did the trade. Okay. At the same time, if I add too much in the sessions, sessions are already quite dense with content. So I'm trying to find a balance with keeping it as simple as possible while it's pretty advanced stuff that we do. But yeah, I'm with you, Maca, and there is a lot of automation that you can add, such as price triggering conditions. Like you could have closed CL using a triggering condition when the stock reached that level. You could have set an alert on TradingView, for example, and when that stock reaches that level, you get a pop-up message on your phone, and then you go close it manually. So you could manage it in so many ways, and for sure, we'll need to talk about these too, which varies from platform to platform, okay? Yeah, good. Thank you, Joanne. Thank you so much. Okay, so now what am I going to do? Well, what I'm going to do now is I want to compare my trade with all those various units to what if I was to get rid, okay, what if I was to get rid of the put side? So if I get rid of the put side, I want you guys to be aware that let me rephrase that, the directional butterfly cost me $52. So if I get rid of the put side, right? Remember we have two bull put spreads below. If I get rid of that, okay, then the total risk left in that position is $50 per contract. So you can see here in orange color that, if that market rallies to 48, you make some amount of money. And if the market is, below the break-even points, then the most you can lose. Let me bring the data window again. So the most you can lose is $50. Why? Because a directional butterfly is a debit strategy, and the most you can lose is what you pay for it, which is $50. Okay, so so keep that in mind. This trade is made of two bull put spreads that in the end ended up creating a butterfly. If I was to get rid of the bull put spreads, I would be left with $52 of risk. Okay, $52 of risk. Now, bear with me. So now let's do the opposite. So I copy the original again. I'm going to edit the spread. And now I'm going to get rid of the butterfly. So now I'm only leaving the put side. Okay, my two puts. So if I chart my two puts, okay, what are my two puts doing at the moment? Okay, so my two puts are a trade, okay, which when I got in this trade, I collected a credit of 66 cents, okay, where if I was to close this trade right now, okay, I would pay anywhere between 24 to 26, okay. So let's bring a calculator, even though I guess it's quite obvious. So if you got 66 and to get out, let's say you get out at 25, which is the midpoint, So that means that you make $41, in this particular trade. Okay, this is what it is. The credit collected was, let me highlight on the screen, 119, and then you paid 86. So if you take 119 minus 86, you collected 33 cents of credit per bull put spread, and because you did 2, that's why you can see that you got 66 cents total of credit. That includes both bull put spreads. So if you close this trade now at 25, as I said, which is the midpoint between, actually, I should say 26. Okay, so then you will make $40 on the trade if I close it now. Which, by the way, you don't need to do the math. I'm just going through the math with the calculator so you understand where I'm going. But you just need to focus on the pink value, which is $40. This is telling you got the pink color here. You have the check mark where the pink color is. You have the pink risk graph, and you have the pink P&L. So this is the real-time P&L that those two bull put spreads are bringing in. So in other words, if I close the bull put spread now, okay, if I was to do that now, what would the result be, right? So what would the result be? So the result be is that, I'm left with a butterfly that has a risk of 52, but I just collected a profit of 40. And therefore, what's the most I can lose? Well, the most I can lose is the difference, which is 12. So there's still risk, okay? But as time passes, what's happening to these bull put spreads? They are losing value. If Pfizer was to rally just a little more, what would happen? So what would happen is that the bull put spread may gain a bit more value because the bid and ask prices go down. Okay, puts are inversely correlated with the market, so the bid and ask prices go down. So now instead of $40 of profit, you will now reach $52 of profit. And what would the magic be now? Well, if you close that trade for a $52 profit, okay, what's the beauty? Well, the beauty is that now your butterfly that has a risk of 52 basically has no risk any longer, because now you just made 52 with the put side, right? So now you're left with a butterfly that cannot lose for you anymore. And then if the market rallies, that's it. So I'm kind of, if you think of what I'm trying to do here, it's almost like, the word that comes to my mind is like a strangle, meaning that if Pfizer falls, let me use an arrow. So if Pfizer falls, right? So what's likely going to happen is that the two short 48 calls will be closed at 5 cents. Okay, and that's a benefit for the trade, because then if the market rallies, I could potentially make more. Now, this is if the market closes. Now, what if Pfizer rallies? Well, if Pfizer rallies, okay, the bull put spread will lower its value, and then I can close the put side. And what's the benefit? Okay, if I close the put side, the benefit is that now the trade has no risk any longer. And if you reach the target, it's perfect. But if you don't reach the target, now you have this beautiful peace of mind knowing you cannot lose. Okay, and then there are more steps actually you can take after that, but that would be too much for today. So that's why I was thinking of, in my mind, the word that is popping up is the word strangle, meaning that if it goes down, I strangle it from the upside. If it goes up, I strangle it from the bottom part. Okay, so that's what I'm thinking to do. So now the key question is, I cannot close the put at this price. I cannot do that. If I do it, then I have a problem, right? The problem is that I'm locking in on a risk of $12 because currently it's making only 40. I want the bull put spread to make 52, right? So let's do a little bit of math, right? So if I want the bull put spread to make 52, and I know I collected 66, so that means I need to close this for a net cost of 14. But remember, I got 2, which means I need to close, my closing price is actually 7 cents, right? So if I can close the bull put spread at 7 cents, right? Let's simulate this. So if I copy the primary spread one more time, right? And now I enter 2 more legs, right? 2 more legs, which are going to be 2 units, 2 units. One is buy, one is sell. And it's going to be put and put. And just to make it simple, one I'm going to make it 0, and the other one I'm going to make it 0.7. So I'm simulating what's going to happen if I close it at 7 cents. So the puts are the 43 and the 42. So let's say I buy back the 43 at 0, and I sell the 42. Actually, it's the opposite. Buy back the 43 at 7 and buy back the 42 at 0, meaning I lost the whole thing on the 42. So if I do that, okay, this simulates what happens if I close my bull put spread at 7 cents. And you can see now how, if you look at the green line, what's the risk on expiration? Nothing. No matter if the stock drops all the way to whatever, or no matter if the stock rallies all the way to whatever, I cannot lose. And now if the stock gets to 48, I'm going to make a nice profit. Okay. So my intention now is, just like I placed an order to close the short 48 calls at 5 cents, now I am going to place an order on Pfizer to close the put side, right click, create a closing order to close this bull put spread, which is a vertical spread made of the 43 and the 42 put, which if you do it right now, the current price is 13. I want to do that at 7. I don't want to do it at more than 7. If I do it at more than 7, I have risk. But if I do it at 7, then basically this trade is risk-free. So I'm going to have a good till cancel order to close those 2 bull put spreads at 7 cents per spread. And when I confirm and send this, now I have that strangling style management. Not sure this is a valid term, but I guess you are with me now after the explanation for today, where if the market goes up, the puts will lose value. So hopefully I can close it at 7 cents soon, tomorrow, the day after, Monday, and then I have no risk anymore. And if the market goes down or goes up slowly and time passes, I'll be able to close those 48 calls at 5 cents. And therefore, now I open up for more profitability to the upside if Pfizer was to have another nice push, just like it had before. My friends, that was a lot to take in, okay? But if you think about it, it's really not that complicated, but I wanted to go one step at a time here using the compare function on the risk graph for you guys to be able to see the visual effect of my decisions here and you know, what is it that would happen. Could you please give me some confirmation? I'll take a sip of water. Some confirmation that you guys are with me, you are following. This is advanced, I understand, but you have to get this, my friends, because it will make a very big difference in your trading. Remember the concept of, you know, sometimes we get into trades that don't work well. This has happened for a while, by the way. And guess what? If a few of them, you reduce the risk, and a few of them, you save them to become break even or to make some sort of a profit. So what's going to happen at the end of the year? That makes a major difference in your account performance. Okay, and this has other effects such as boosting your confidence level. And now you trade when you have to trade instead of sometimes you skip a trade because that day you were not feeling confident and things like that. And again, I personally love this. Okay, but again, it's a little bit on the complex or advanced side. So hopefully you're appreciating that. I also plan, by the way, to run some sessions to be very simplistic. Okay. We don't need to always do like super advanced style of trading. Sometimes I guess it could also be appreciated or useful to some of you, depending on your approach to trading options, to run sessions where we just go for those very simple, easy trades with no management, which could also pay okay. even though my favorite approach to trading is to be more in the active side. Okay. Missy Joe, with the bid of the long put at 12, would it be good to leave that as a hedge? You could, but normally, Joe, when you think of a hedge, it's kind of better to hedge your portfolio instead of hedging a specific position. Because if you plan to hedge one position at a time, it means that you need to have as many short deltas as long deltas, which means that you never have a clear directional bias on the portfolio. So I'm not a fan of that. And I get your point, Joe. And again, you make a lot of sense. Like, you know your stuff, my friend. I know. I get your point 100%. But, again, when an option is worth 12 cents, it means that the delta is very low. It means it's far out of the money. It means probably the option will expire worthless. So could it be that sometimes it works well as a hedge? Yes, 100%. But based on probabilities, you should expect that the majority of the trades throughout a whole year of trading would imply that those 12 cents options, you could have closed them for 12 cells and kept in your pocket 12 cents that otherwise you would have lost. And that one trade or those two trades a year that may pay you, probably when you put together and you do the math of all the 12 cents that you left on the table versus that day where you got a big winner thanks to that option, probably you would conclude that it was not worth it. Okay, that would be my take. So I would rather put a hedge for the portfolio, trying to be precise with the timing for the hedge. And if the whole thing goes down, you have a powerful hedge with a greater amount of delta, because again, that 12-cent put will have a very low delta. So it's only going to hedge if you have a huge move against. It's not going to hedge unless the move is great. And if it was to hedge better, then it would not be 12 cents. It would be much more than that, because the delta would be more, therefore the premium would be more. So I guess you are with me and you get my point. I also get your point. So in the end, it's all about trader preference, trader, style. Have a set of rules around it in your trading plan and just act according to that. Certainly, I would recommend you to backtest that, or at least if you're going to do it, track it. So 6 months, 1 year from now, you can look at what if scenarios of what happened if you had done it versus what happened if you didn't do it. And then, that will kind of confirm what you think is best in your particular case. Okay? Got it. Siderman, understand order as in. Siderman, I don't think I could figure it out for myself. I get you. That was a long conversation. I mean, it took me the whole hour almost. Okay, we're almost touching the top of the hour. So let's do this. Okay, let's do this, Siderman, if that's okay. You have the recording of the session. Please watch it again carefully. If you have questions, just email them to me. And in the next session that we are together, I'm happy to go over it again, re-explain it, and whatever is needed, because believe me, guys, I truly believe you guys need to get this, okay? And at the same time, while it looks very tedious, think about the first time in your life you traded a spread, right? So you went from buy a call to buy a call and sell a call. And, if you're like most people, if you're like me, probably that was confusing, like really confusing to do spreads. And now one day you did your first iron condor, and that was like crazy confusing. But I bet you, I'm pretty positive, if you are in the sessions in a regular basis for a while with us, I'm pretty sure that iron condors and spreads are not a mystery to you any longer. So the same thing happens with this. Okay, it looks tedious, it looks complex, it looks confusing. Yeah, just do it 10 times and you see it's not. Okay, so at the same time, you need to understand it so you can actually do it, practice it, and do those 10 repetitions. So counting on you to watch the recording, and of course, you guys count on me. If you have questions, I'll be here to support you. Okay, guys? Now, Maka, I said earlier in the session that I was going to talk about the assignment. I won't have time today, but I'll do it tomorrow, guys. It's an important conversation. Mark, this is also important to you. Okay, so please keep handy the notes that you type on the chat box today. Maybe you want to copy paste on a Word document or something. So tomorrow you can paste those notes in the chat box one more time, because tomorrow we'll talk about the Colgate-Palmolive trade, the issue around assignment, around the 77 strike. Anyway, before we conclude the session today, we also need to talk about, very quickly, KBH. okay, which KBH is a trade that it's indeed not working in our favor. That was a trade that we entered as a hedge, and that it was supposed to hedge to the downside, and as you can see, this market just went up and up and up. So what we did to this trade is that we ended up acting on it. Step one, we closed one of the put. Step two, we made it a butterfly, a directional butterfly, but with nearer strikes. So with that, we reduce the risk, and you can see how, even though it's not significant as so far, so the trade is losing less. Instead of 165, it's losing 150. So the trade is doing the right thing. So that's great to see. But anyway, still more time to go until November 19. And we'll talk more about this in case we can do a bit more to tweak it. So far, there is not much more we can do. What else? What else? We'll talk about this tomorrow, KBH. COF, okay? So this one is now showing some profits, okay? So COF, which was a trade that we entered the other day, that was actually from the 3-day time frame, if I'm not mistaken. So that particular stock, let me make this larger. That particular stock got into the speed bump. If you recall, okay, there was this 139 UFO way below. So what we ended up doing there is selling puts. Okay, we sold 2 of the 139 140 put spread, and then we bought the 174 call in exchange. Okay, so this is a trade similar to Pfizer or CL, the way they started. The difference is that the stock started moving in our direction, not by a lot, but a little bit. Okay, 0.75% today, and therefore we start seeing how those positive deltas are bringing in some profitability. So we don't really have time to look into it more in depth. It's also a bit early, to be honest, because this trade has January 21st expiration date. So before we can do something interesting to this trade, we need to see a bit more price movement. But in any case, happy to take a look at this tomorrow as well, so we can see if any management action could be smart to apply, again, as the market is moving higher. So, this is the whole thing, right? I always talk about it, that stocks are fragile. They are beautiful to trade. There are thousands. It's amazing. But they depend on what's the S&P doing, what's the sector doing. And in this sense, as the S&P was going down, you can see how Pfizer and CL were not following up to the upside. Even though they were strong stocks in a strong industry, they were not going up because the S&P was going down. But now as the S&P was going down, so COF that was being killed, falling hard, well, guess what? It belongs to a strong industry, and as the S&P is going back up, we get to see that reaction. And we have a backup plan with UFOs way below in case it keeps falling, because it was quite weak. So we gave ourselves that wiggle room for that stock to continue to the downside without really hurting us that much. So all looking good in this sense. And so we'll keep talking about how those trades evolve. In the meantime, I guess that would be all for today, since we reached the top of the hour, and we will continue tomorrow with more very quick review of those trades. As I mentioned, probably we won't do anything to those trades. Then we'll talk about the assignment. Okay, very important conversation. If you cannot be here tomorrow, it's okay, but you'll find it in the recording. Please watch it. And then we'll look for trades. Okay, we'll look for trades, which today I didn't have time at all, because we got into a very lengthy conversation that was indeed needed. Okay, because again, what a great way to manage a trade, right? If it goes up, there is action to remove risk on Pfizer. If it goes down, there is action to unlock more profitability. So we are kind of having this strangling style approach to the trade management, which again, that pays well, as especially after a whole year of trading. That makes a big difference. So I'm very strong on this approach, where you guys need to listen carefully and learn it. If you want to be an advanced options trader, you don't have to be. You can be an options trader using one strategy only, and that's what you do, and that's fine too. But if you want to be an advanced options trader, you gotta master this type of tweaks. Okay. So anyway, well, for the Indian community out there, happy Diwali, my friends. I don't know if you hear all the fireworks in my background. The sky is exploding behind me. I guess that noise canceling maybe stopping that sound going to you guys. But anyway, for all of you that belong to the Indian community, guys, very, very, very happy times. So happy Diwali. You guys take care. See you tomorrow, same place, same time. Bye bye, everybody.